Welcome to the first episode of the second season of Beyond the Charts, which is a show where we dive into some of the most interesting charts from the world of economy and finance. Ever since we ended the first season, a lot of you all have told us that you loved the show and you wanted us to bring it back, so here it is for you. I'm your host Anurag Bansal and this is the first episode of this show. See, we're now about halfway through 2025 and in about the last 6 months, the global economy has seen a big series of shifts, from new trade policies and rising debt levels in the US to softer inflation in India and also shifting investor flows across markets. There has been a gradual change in the way capital, confidence and risk are moving around the entire world. Now, one of the most important round of developments this year came in early April when the US announced a new round of tariffs. Now, these, of course, as you might know by now, are taxes on goods that are imported into the country. And this was not a small adjustment. The average US tariff rate went up to 15.8%. That is the highest that it has been in nearly 90 years. And of course, while the final number was lower than the initial announcement, it still marks a clear break from the kind of trade policy that the US has followed in recent decades. Now, this shift has created a sense of hesitation of sorts across the entire economy because when trade rules change so sharply, businesses and consumers tend to wait and watch. Companies also hold back on investments and households pause big purchases, and needless to say, markets become harder to predict. Now, one early sign of this slowdown can be seen in container traffic between China and the US. To give you a sense, the number of containers that leave Chinese ports for American shores has clearly dropped. And while I know that might seem like a small operational detail to some of you, the truth is that it is often one of the first indicators that global trade flows are being disrupted. But again, trade is not the only concern here. The US has also introduced a large new fiscal package, which is also called the One Big Beautiful Bill. This includes both tax cuts and spending reductions, and it is projected to add around $5 trillion to the US national debt over the next decade or so. And if those estimates play out, the country's debt to GDP ratio could reach 129% by as early as 2034. That would obviously be among the highest levels seen in the developed world. Anyway, moving on, geopolitics has added another layer of complexity here. The tensions between Israel and Iran and some recent changes in how the US handles economic sanctions has raised more questions for global supply chains and commodity markets. Interestingly though, despite all of these risks, markets have stayed fairly calm. In fact, S&P 500 went up slightly after the mid-June flare-ups, and oil prices, which are often the first to react, actually fell down this time around. To give you a sense, Brent crude dropped by around 2% and WTI by nearly 4%. Now, the reason why I'm stressing on this region and why it matters so much is because of energy. See, Iran holds about 12% of the world's oil reserves, and it has the second largest natural gas reserves globally speaking. It also produces large volumes of gas and oil. Now, most of that oil, which is about 90% to give you a reference, is sold to China alone. So therefore, any instability that involves Iran raises concerns around energy prices, trade balances, and also diplomatic alignments. But anyway, moving on, in the middle of all of this, something unexpected has happened. The US dollar has weakened significantly. See, the dollar index, which measures how the US currency is performing relative to the others, has fallen by over 10% in just 6 months. That, mind you, is the steepest first half drop since 1973. And what's interesting is that this goes against what usually happens during global uncertainty. So then the obvious question is, what is causing the dollar to fall? See, there is no one single reason. It's actually a combination of multiple factors. See, the US dollar had become relatively overvalued in the last few years. US economic data has not been very strong, and there have been concerns around America's growing debt that have been increasing lately. And some countries are also now pushing back against the dominance of the US dollar, especially as trade and sanctions get a little more politicized. But moving on, there is also something more unusual that's going on in the bond markets. See, typically when US bond yields rise, which basically means that the return you get from buying a US government bond goes up, then the dollar strengthens. But this time around, bond yields have actually gone up while the US dollar has dropped. Now that suggests a deeper concern over here. Investors might be starting to look elsewhere for safety and stability instead of defaulting to the US dollar. That said, let's now move ahead and talk about the capital markets. See, across the board, the picture is fairly mixed here. Some segments are recovering, others are still cautious. Mergers and acquisitions are up by about 25% this year, but that increase is being driven by just a few large deals. The total number of transactions is the lowest in the last 2 decades. And that suggests that while large and well-funded companies are still fairly active, the smaller ones are a lot more hesitant to make moves in this uncertain environment. And if you talk about IPOs, the story there is very similar as well. See, even though total equity fundraising is up about 7%, the number of new companies going public is down by 11%. Basically, more firms are choosing to stay private and they are raising money through venture capital or private credit instead of actually listing on public markets. And this trend has been building over the last few years, mind you. In 2024, the average age of companies going public was about 14 odd years compared to just 8 years back in 2004. That's a big change in how companies think about growth and liquidity. But moving on from that as well, but at the very same time, bond markets are showing very strong activity. Large and financially stable companies are raising more money through bonds than in almost any previous year, except 2020, which was during the pandemic. Investors basically seem to be favoring safety and they are buying bonds from companies with solid fundamentals. There has also been some renewed interest in riskier high-yield bonds in the last couple of months, but overall speaking, the focus has been on lower risk options generally. Government bond yields have been moving within a very narrow range. The US 10-year Treasury yield stood at about 4.47% by mid-May. The shape of the yield curve is also shifting over here. Long-term yields are beginning to edge past short-term ones once again, which is a signal that markets are expecting interest rates to fall over the long term. Also, the term premium, which is by the way the extra returns that investors demand for holding long-term bonds, is also rising over here. And that usually is a sign that people are starting to worry about future risks like, let's say, rising inflation or government debt, and they want better compensation to lock in their money for longer periods of time. Now, moving ahead from all of this, let's now talk about how the stock market has done. See, the stock markets have been mostly stable. The US market saw a dip after the April tariffs, but have since then recovered pretty well. Global markets, in fact, have outperformed US equities so far in this year. That is worth noting because for the last 15 odd years, the US has led the world in terms of growth, innovation, and also investment returns. But this year, some of that leadership is actually showing signs of weakening. Foreign investors are becoming more cautious about the US, the dollar is not gaining during global stress events like it used to, and US stock valuations are high, and of course, the country's fiscal deficit continues to stay at levels usually seen only during crisis. And in contrast, more money is now flowing into European and Asian markets than we have seen in many years before. Governments are also leaning more on private capital to meet their funding needs, especially in areas like infrastructure, clean energy, and AI or artificial intelligence. So with public budgets under a lot of pressure, private investors are now suddenly playing a much bigger role. Global private infrastructure assets under management are expected to cross $2 trillion by 2028, with the bulk of that growth happening in the US and Europe. Defense budgets are rising as well. European NATO countries are finally hitting their target of spending 2% of GDP on defense. Germany, for example, has announced a massive €1 trillion plan for defense and infrastructure. Similarly, Japan has also increased its defense budget by 9.4%. Now, all of these changes basically show us a much larger trend. That is, governments are rethinking their priorities in response to a more uncertain world. Anyway, now let's move on and come to our home country, which is India. See, the Reserve Bank of India released its latest financial stability report recently in the month of June. If you're unfamiliar with it, this is basically a biannual report that gives us a very comprehensive look at how India's financial system is doing, which includes banks, corporates, households, and also the others. Now, in the foreword to this report, RBI Governor Sanjay Malhotra pointed out that the US tariff announcements have set off a new kind of trade environment globally. This is one that is harder to navigate and it may keep growth under a lot of pressure. In fact, global growth forecasts have been revised down by major institutions like the IMF and the World Bank. But interestingly, India's outlook has stayed fairly steady. The economy is expected to grow at about 6.5% in 2025-26, which is about the same as last year. That is largely thanks to our strong domestic demand, stable macro fundamentals, and also a reasonably sound policy management. Inflation has also cooled down. In May, for example, consumer inflation dropped to 2.8%, which, to give you a reference, is a 6-year low. Food inflation came in at about just 1.5%, which gave relief to households and also improved consumer sentiment at scale. Liquidity in the banking system, which was fairly tight earlier this year, has also eased in the recent few months. The RBI injected 9.5 lakh crore rupees into the system through bond purchases and other tools. It also announced a phased reduction in cash reserves ratio between September and December, which will basically unlock another about 2.5 lakh crore rupees for banks to lend. And this shift is also showing up in the bond market now. Short-term interest rates have dropped faster than long-term ones, and that's usually called a bull steepening of the yield curve. It basically suggests that markets expect more rate cuts going forward. Anyway, one more trend to watch out this time around is the shrinking gap between the Indian and the US bond yields. Now, the difference between the 10-year government bond yields in these two countries is now at a 20-year low. That could impact how attractive Indian bonds are to foreign investors. Stock markets in India have mostly recovered after a dip earlier this year, but foreign investors have been steadily pulling money out. Their share in Indian equities is now at about a 10-year low. And if you think about emerging markets more broadly, they saw about $40 billion of foreign outflows in the last quarter of 2024, which is the largest quarterly outflow ever since COVID-19. But despite that, Indian markets have not suffered much, you might have noticed. And that is because domestic institutional investors, which are like mutual funds, insurance companies, pension funds, and so on and so forth, have stepped in to protect the markets. In fact, domestic investors now own a larger share of Indian equities than foreign investors for the first time in many, many years. Retail investors are also playing a bigger role now, but most of their exposure is still in micro-cap stocks, which are smaller companies that carry a lot more risk. Their presence in larger and stable stocks is still relatively limited. But anyway, valuations are another interesting area to keep an eye on. They have come down from earlier highs, but they still remain expensive by historical standards, especially in the small cap and mid cap space. As of March 2025, about 2/3 of listed stocks were trading above their long-term average price to earnings or PE ratios. Despite global uncertainties, Indian corporates have done reasonably okay. Profit margins are holding up even while sales growth have slowed down, and corporate debt levels remain low as compared to global peers. And that of course gives companies some flexibility if profits do come under the pressure in the coming months ahead. Anyway, moving ahead, India's banking sector continues to be in a very strong shape. Bad loan ratios have hit multi-decade lows. To give you a sense, gross NPAs are at 2.3% and net NPAs are down to 0.5%. Capital levels are also at record highs of 17.3%. Now, these improvements have come gradually over the past few years, which are driven by better regulation, improved underwriting, and also a cleanup of legacy issues. Stress tests also show that even under adverse scenarios, Indian banks are expected to stay well capitalized. Household debt is rising, but it is still manageable. As of December 2024, household debt stood at 41.9% of GDP. That is up from earlier levels, but it is still lower than many other emerging markets. Now, what's changing is a composition of that debt. A growing share now comes from personal loans, credit cards, and also consumer finance. Now, these now account for about more than half of household debt and are growing faster than home or even farm loans for that matter. A good news here is that this growth is being driven by high-rated borrowers. Now, these are people with strong credit histories, so the overall quality remains fairly stable. Anyway, finally, the report also touches on the rising influence of non-bank financial players, which is like private equity firms, hedge funds, asset managers, and also insurance companies. Globally, these firms now hold nearly about half of all financial assets. But again, they often use a lot of leverage, which basically means that they can be vulnerable to sudden market shocks. And if we talk about India here specifically, NBFCs remain healthy overall with good capital levels and low NPAs, but their loan growth has slowed recently, largely due to the RBI increasing capital requirements on certain loan categories. The RBI also conducted its systematic risk survey in May 2025, and the results show a sharp contrast in sentiment. About 2/3 of respondents say that confidence in the global financial system is weakening, but more than 90% of them felt confident about India's financial system. But anyway, that said, they did flag some risks. Geopolitical tensions, capital outflows, and a slowdown in global trade, especially exports, are seen as the top short-term concerns. Export-heavy sectors like manufacturing, MSMEs, and logistics are considered the most vulnerable here. So with all of that said and done, while India's economy and financial system have held up fairly well so far, the broader global environment remains fairly uncertain. And the next few months will likely test how really resilient that entire stability of our country is. That's all we have for this episode. We'd love to know what you think about it and maybe what we can do in the next episodes to improve. Please do share it with us in the comment section down below, and we would love to have a chat with you. Anyway, this is your host Anurag Bansal signing off for this episode. I'll see you in the next one. Take care and goodbye.